Hello, friends. Since the Masters was referenced in our lightning round questions each of the last 2 weeks, my partner Mike Manning suggested that I kick things off with Jim Nantz and Augusta reference, harkening back to more normal times and thinking about springtime with the Masters on. So there we go. So hope everyone's doing well. This is Tim McCusker, Chief Investment Officer of NEPC, and happy to welcome everyone back for our CIO conversation series. I'm excited to have with me today Rajiv Jain, Chairman and CIO of GQG Partners. Rajiv, thanks for joining us today.
Thanks for having me, Tim.
Absolutely. And Rajiv, just before we get into things with you, and really excited to hear about your worldview, want to just let all the listeners know about our upcoming guests. So continuing to do these Tuesdays at 4:15. Next week, we will have Rick Reeder, the CIO of Global Fixed Income from BlackRock. We're going to take a week off right after the Memorial Day holiday and kick things up again on Tuesday, June 2nd with George Walker, the Chairman and CEO of Neuberger Berman. And then Tuesday, June 9th, we'll have Robert Smith, Founder, Chairman and CEO of Vista Equity Partners. So excited to continue to bring everyone these unique perspectives from really talented and well-known investors, and among them, Rajiv Jain. So Rajiv, thanks once again for joining us today. Maybe we'll kick it off just hearing how you personally and how GQG has adjusted to working from home and being in lockdown, what for now is probably 8 weeks.
Yeah, thanks, Tim. So it's been like anything else, it has gone in cycles. There was quite a bit of anxiety in the early days, and then you kind of get the rhythm of it. So, but net, I think we've done, frankly, I would have said better than I would have expected, which is how the equity investors tend to look at, or beating expectations. So starting from low expectations, because they were kind of a little bit anxious period. And we actually went through lockdown fairly early. So investment team we went working from home last week of February, actually. So it's been almost 10, 11 weeks now.
Wow, that's and Rajiv, you and your organization, you're in Florida. That must have felt particularly early down there, where I know we were talking. Florida was a little late to do the lockdown, and has maybe a little bit lighter in their lockdown, and has been earlier in opening things back up. So good for you guys for being early on it. What's the feeling down in Florida right now?
Yeah, so you're right. Because of the spring breakers, the governor probably didn't want to close down early enough. But by middle of March, it had begun to sort of close out. I think again, if I look at the demographics of Florida, one would have expected a higher number. And I think there's a lot of cruise ships coming in here, even till middle of last month, with at least a few, if not more than a few patients. So net, I would say it's been a lot less than what people were expecting, especially looking at demographics, and the fact that basically whole of South Florida, especially, was open till middle of March. But I think obviously weather helps. It's been warmer than most of the other places, but I think it's been less, especially in the nursing homes, etc. Which where the biggest fear was of high mortality.
Sure. Yeah, that's been a flashpoint in a lot of different regions. Well, that's good to hear. And so let's get into your outlook on the world. At GQG, you are global equity investors. You have a perspective that spans the entire equity investing universe. Let's maybe start with where you saw things coming into this and how COVID-19 has changed your view throughout the world.
Yeah, so going into the second half of last year, especially the fourth quarter on, our view was, and that's based on the bottom of companies that we talked to, and we talked to literally dozens, if not hundreds of companies. Our view was that the earnings growth would accelerate, the world was coming from a low ebb, and things should accelerate. And early part of the turning over in January, we actually were overweight, generally speaking, financials, for example. We also had some energy exposure and the like. And as things began to transpire in China, and having run global as well as emerging markets during the SARS, I was somewhat familiar with the scenario or the risk of the spreading. So we did start reacting to that, and we started cutting back some of the more cyclical exposure we had in January, which is why we started reacting even at the company level in February. In fact, we started canceling some of our international trips in first week of February thereabouts. So on the portfolio side, we started reacting, and I think one of the few data points which actually turned out to be more powerful than I thought. As you know, we have former investigative journalists who can be very helpful, and one of the things we did was talk to hospitals here in a few different places in the U.S. And one of the data points was that the hospitals or the doctors were not even allowed to test for COVID till literally last day of February. And that was kind of surprising that I remember some of the feedback getting from the ER doctors that they weren't even allowed to test. And that kind of was alarming because that meant the numbers will go up. Once they start testing, the numbers will go up, the risk of shutdown increases. And that sort of allowed us to react a little bit quicker in cutting back because we know that these things, once they go into lockdown, it's just hard to predict. So that actually helped us navigate a little bit better in cutting back risk in both the developed as well as emerging markets.
Interesting. And so tell me a little bit more about how you've shifted your positioning as and the world is a lot different than even late February when we started thinking about going into lockdown, and from there states mandating that we go into lockdown. I guess in February, maybe Europe was there. How have you tried to both position your portfolio, but how are you thinking about the world going forward with everything that we're going through right now?
Yeah, so I think if you look at the and I'll divide into the world into two parts. Countries which had the ability to manage this just from a fiscal perspective, other countries we don't have that. So some emerging markets will be fine, others won't be. Some developed markets will be fine, others probably would less so. So I think our view is that you really have to divide the world into sort of three buckets, and I would call it the first degree. Just like you get, first degree burn and second degree burn and third degree burn. In other words, how deep it gets. The first degree is where you have seen a direct impact, kind of eye of the storm, travel, hotels, leisure, maybe some luxury goods, maybe some banks in certain sort of weaker countries in terms of where they have huge fiscal or current account deficit or combined thereof. Think about Brazil, for example. Think about Mexico. Think about South Africa, Turkey, where it could be more problematic. Italy, Spain, where it will be more problematic. The second degree would be where the impact is shorter term, longer term probably should be fine. The third is where we feel the bills are okay, but you got to watch. So second would be, for example, it's banks in certain areas. There would be some other, even Coca-Cola, for example, where the business, if you look at the volume decline that March, was very steep. I mean, you talk about double-digit volume decline, actually 20% plus volume decline for companies like Coca-Cola. You've seen some of the credit card companies or the payment networks see decline. So our view is that these businesses, which are fundamentally sound longer term, should rebound but need to be watched. And the third is the one where, if you look at some of the utilities which are not as impacted, you get some software companies where if the duration, and I think the real question is duration, if the duration lasts long enough, this will seep through the second as well as into the third bucket. So our view is that you need to be very careful about owning anything in the first bucket because, and I'll give you one data point, the global GDP decline during GFC was around 0.1%. I mean, basically flat. This during GFC and around global GDP. It was much deeper in US and UK, for example, but globally. This year, the expectation around 4%, right? So what matters in this, and we feel from an equity investor, first and foremost, is balance sheet. So one of the things, if you look at the numbers, and we wrote about that, is that if you look at the first quarter and divide the world into 10 deciles purely based on Altman Z-score, essentially, which predicts the risk of bankruptcy, the best decile or the highest decile outperformed the lowest decile by 1,500 basis points. Okay. Now, the interesting thing is that the markets were not paying a premium for balance sheet quality. And I feel that balance sheet quality actually still is not as expensive as people think. P&L quality is expensive. So most of the folks tend to focus too much on P&L quality. Think about return on equity, stability of that. Most of the low beta or low vol funds tend to have a lot of P&L quality, not enough of balance sheet quality. And if the duration lasts longer, we feel that you need to take care of the balance sheet quality first, and then you look at in terms of what the forward-looking aspect of the business, how that's evolving. And you rather go in the second or third bucket, and mostly in third bucket, because I feel there'll be plenty of time to react. And the good news is that's where the dividend will be more secure. The earnings growth obviously would be lower, but it's much more certain. And you don't have to go. Actually, you don't have to go to software or those kind of business too much, because there the valuation gap might be too high. Because I'm not so sure a lot of the tech names will be as bulletproof as some people think.
Interesting. So I'd love to spend a little time on that in the third bucket, but I feel like maybe more interesting is the second bucket first. That those companies that are okay, but maybe a little bit more vulnerable, because that it feels to me like that group is exposed to anything that disappoints beyond that -4% that you mentioned. If GDP growth is even lower than that, I think that -4% assumes a very painful second quarter, but a recovery of some kind in the third and fourth quarter. Maybe obviously not all the way back to 100 if we're going to be down 4%, but it assumes a nice bounce back if we're looking at something like what the U.S. and China have experienced, which is going to be down 10 to 15% quarter over quarter. How long do those second bucket companies have? What are you looking at to differentiate those companies?
Yeah, so the biggest differentiator actually, I feel sitting here and now, is that the markets already begin to sort of tell you which are the second bucket companies. That I find fascinating because, for example, if you look at the healthcare space, even the elective surgeries are not being done or they're being postponed because the hospitals wanted to keep space open for COVID patients, right? So the question is, they're obviously the second bucket because the business has shrunk quite a bit now. I mentioned some of the beverage companies, some of the alcoholic beverages, for example, and these are typically very defensive businesses. Alcoholic beverages tend to be very defensive, except this time the on-trade restaurants, bars, are not the same. And I think even if you look at China, the traffic is a lot lower. So the restaurant might be open, but the traffic is a lot lower. So, but bulk of the profits for a typical restaurant would come in few days and few evenings, right? So if you have 30 or 50% occupancy, the restaurant won't be break even or profitable. So if you look at the alcoholic beverages companies, that'll be one example where you should expect that they should as things normalize, probably last quarter of this year, early next year, they should normalize. The tricky one actually is financials, especially the U.S. financials and some other financials, where they entered this crisis in a fairly good shape. They looked very cheap, and we had significant financial exposure actually going into February. That's where the question of forbearance, I think, is important, because if you look at, and I think that's coming from my emerging market experience over the longer run, that when you go crisis like this, you really don't have a good sense in developed market. You really have to look at from what happened in select emerging markets when you got a deeper crisis. And the risk of some sort of national service goes up. And that, I feel, is the real risk on the banking side, because right now there's a forbearance a few months. Could that be extended? So if you get longer lockdowns, could that be impacted? So I think that's where I feel you really have to be very careful, because if the banks have to pick up the tab, let's call it national service risk, and Chinese banks have done that for a while, by the way. I wouldn't be surprised that'll spread in other countries too. Could that spread in Southern Europe? Could that spread? Could that even happen in the U.S.? Especially after election. So or if this, even before election, if the shutdown extends longer, or if the normalcy doesn't come back fast enough. So I think financials would be a big area where you have to watch for whether they go from the second to first bucket.
Interesting. And I would imagine in that case, at least today, the U.S. financials would likely fare better than at least European counterparts, because there's some potential, some precedent for the Fed to step in and be able to print money, where you mentioned some of the country differentiation. Other countries don't have that luxury of being a reserve currency and being able to print.
Exactly. So I think U.S. in a much better position than a whole host of countries. Europe, there are few countries who will be better positioned. And by the way, one of the fallouts of this would be, and I don't feel is enough being appreciated, especially on the equity side. Fixed income guys or folks always, look at that, is the country differentiation. So could the country differentiation start coming up in Europe? Is Switzerland safer than some other parts of Europe? Well, if you go back to 90s, that was pretty normal to compare and pay premium for certain countries. And I think that should come back as we go forward. So you're absolutely right. I think U.S. financials went into this in better shape. However, we are in one of the things that gives me pause is that we are very, very early days into this. I mean, from a economic crisis perspective, we only 10 weeks, give and take, right? So it takes time for things to sink in. And if you look at the banking system, they talk about 40, 50 basis point provisioning. That in grand scheme of things is still not that high. So the banking system should be fine, but they have to pick up the tab a little bit more, not impossible. But clearly U.S. is in much better shape than some other parts. But I think China should be able to handle it well. The parts of Europe, that'll be fine. But financials, especially in financial, the country will matter.
Where does that country risk, where do you expect it to more likely flow through? Will it be through the equity returns of the companies within that area, or will it come from the currency?
Yeah, so I think it'll come in Europe. It'll come from the equity return because obviously, unless Europe fails or something, which I don't expect.
Sure.
In emerging markets, it'll manifest itself at the currency level. For example, Brazilian real is down more than 30% in a matter of 6-7 weeks. Indonesian rupiah is down sort of a lot less than that. Taiwanese dollar or Thai baht is not down at all, give and take. Right? It's flat because they have meaningful current account surplus. So you do have to incorporate that in emerging markets currencies. But a bottom-up stock will matter in almost every area because sometimes you may have an export-oriented business in let's say Italy, then it's a lot less relevant what's happening in Italy as such.
Great. Let's go back to the software companies, and then I think it'd be great to spend a little more time on the countries. You mentioned that there's some risk of the software companies and your third bucket companies in general being at risk the longer this goes on. Maybe before getting into those the specific areas that are in the third bucket and how that might happen, can you talk a little bit about the time frame you're thinking about for how long this would have to go on for those companies to be negatively impacted? It seems like the market right now is rewarding those companies, maybe appropriately, and ignoring that downside risk.
Yeah, no, you're absolutely right. So if you look at some semiconductor names, software names here and in Europe and other places, which are basically rebounded to close to all-time highs, and because the work from home has created, obviously created incremental demand, which wouldn't have been there. So it kind of offset some of the IT spend would have had, which has slowed down from an enterprise perspective. But if that's the work from home, you already bought the PCs and desktops, so you're not going to keep buying them, right? So there should be a slowdown. The other part is that if you look at the Chinese data, we feel that the Chinese data that you're seeing today is a little bit, you got to be a little more careful. And this is coming from the much more grassroots work that we tend to do, is because a lot of orders from Jan and Feb were not canceled, and they are now being fulfilled in a lot of export-oriented units in China. The question is, they wouldn't really have orders once they are fulfilled. So the question is, could some of those areas hit an air pocket as we get to August, September? That's the question. But on the other side, some of the business should be okay. But from the tech perspective, I think the real risk is that if you look at, for example, software names, would the company start negotiating? In fact, one large software company just a couple of weeks ago said that they are, and the statement was much more in terms of trying to help their customers. But if you're willing to, sort of push out the payments or agree to reductions because it's a high margin business, especially if you go, let's say, beyond 2 quarters in sort of lower growth mode, could that become real in a lot of areas? And we have seen some software companies talk about that, on one-off basis.
Okay, and pivoting to the countries, you mentioned, we talked about financials, that China and US should be okay. Europe might have some challenges. How about more generally, which countries do you see, whether because of their virus response, because of their sector composition, because of underlying trends that have been in place for a long time, which countries do you see having the most opportunity going forward, and which countries do you see the most risks right now?
Yeah, so I think it's easier to eliminate countries which will have uh, more issues. For example, if you look at Mexico, if you look at Brazil, if you look at Italy, you look at Spain, I think they would have probably more issues. In Asia, by and large, should be okay. Indonesia maybe a little more. India to a certain extent would be a little bit more. But I think by and large should be better. Part of the reason is that the savings rate is higher than others. So in other words, they're not as dependent on foreign capital. So one of the ways you can look at that is the large components of emerging market debt indices are generally the one which are also dependent on borrowing from outsiders, right? That's part of it. And same in Europe. You go to Southern Europe, you typically get more. However, I think I want to be careful not sort of suggesting that you can buy anything in those areas, because financials, for example, even in China, I think the risk of national service has gone up dramatically. So I feel that as you get more and more forbearance, the risk of some banks being forced to chip in some shape or form will go up. So really have to make sure that the business is not vulnerable to intervention, in any shape or form.
Okay, I want to pivot a little bit and just turn to more couple investment approach type questions. The first comes back to a comment that you made earlier about thinking about balance sheet quality, and you referenced the Altman Z score, thinking about credit quality, and I'm wondering if you can compare equity investing and balance sheet quality with what's happening in credit markets right now. Can the credit markets be a helpful signal with all of the liquidity that has been flushed into the system? And then second part to that, what does all that liquidity mean for equity markets?
Yeah, so I think the directionally what you're suggesting is actually what is I feel the best approach in these environments is to think like a lender. Where would you give money to? Because one thing nobody knows, first of all, is this is not 2008, this is not 2000, 2002, this is not even 80, 81, right? The reason is because everything has been financially led. This is not driven by financial. This is a health crisis first and foremost, which means that if you get a resurgence, there's a difference here. And if you look at the experience of 1918, you did get, a couple of resurgences afterwards. So that's a real risk, and nobody knows. Nobody can predict. I mean, the fact is, we really don't have much data on this. I'm talking about, scientific data in how to handicap. You still talk about different type of indications happening because of COVID. So you got to have healthy respect for the fact that we really don't know about second or third resurgence. So I think that's why I feel that first of all, get the balance sheet quality and think like a creditor. And you can take signals from obviously the balance sheet, what they have, or what the bond markets are telling you. Because what's interesting is that even a good balance sheet could become bad balance sheet if the revenue starts shrinking, because it's very hard for any business to take a 50-60% decline in revenue and then still be a good balance sheet. So it's not simply static, but on a go-forward basis. Sometimes bond market or the serious spreads are a much better indicator of that. Now, the other part of the question was, okay, what does the liquidity mean from financial markets? And I think what's happening is that the markets have begun to differentiate. So if you look at the rally from March, it has been very much focused on businesses that are okay in bad scenario and are very good in good scenario. Okay, so if you look at, for example, med tech names, companies that are dependent on surgery, on elective surgeries, they have underperformed. For example, pharma names, where there's a chronic disease and you don't have to see a doctor physically. which is fascinating, where there's a physical procedure involved. You have to go to doctor, dentist, or what have you. Those stocks have underperformed. So the markets begin to differentiate from coming out of this the March lows as such. So I think what's happening is the liquidity has gone into names which are generally defensive, and that itself is kind of telling that the perception is, yes, I want to own names. We have to own names because the alternatives it doesn't look too good. But it's been very focused on businesses that should be okay, and not sort of. It has not been a typical bear market rally. And people have talked about the narrowness. Narrowness actually doesn't bother me that much because that is almost always happens that way. In especially these kind of choppy markets do tend to get narrow. You're not going to get a broad-based rally unless we're coming out of a recession, and nobody can say with any sort of conviction that this is it, right? The fact that S&P is flat over 12-month basis, maybe even up now, it seems a little bit extended. So the liquidity has clearly come in and helped and put kind of a floor here. But I feel that there's been a much more differentiation in terms of the have and have-nots within, and I feel that's where the real cross currents is to differentiate have and have-nots, because there's been plenty of liquidity put in the system, so that's probably putting some sort of floor underneath. The system, there's enough sort of safety net as such, but you still have to pick the haves and be careful of have-nots, and that has shifted. That is a typical defensive business in last crisis or the crisis before wouldn't necessarily be defensive now. So it is not simply extrapolation. Within, for example, even if you look at within staples, some staples have become more defensive, others less so. Alcoholic beverages typically tend to be more defensive now this time. So the liquidity aspect has actually favored. If you look at software companies on the other side, I think the generalized view, one, if you have to sort of summarize it, they should be okay in a bad scenario because it's not capital intensive business, but they're very good in good scenario. So the money has gone in. I don't believe it's necessarily that software is going to be booming as such, because you are looking at a slow growth environment if you take a 3 to 4 view, because of just the unemployment level, globally now. So it's hard to say this is going to be a rip-roaring environment. But to your point, the liquidity has kind of put some sort of floor in, and I think it allows you to differentiate between have and have-nots, which is where I think if you look at the whole value and growth debate is interesting, because on the value side, a lot of businesses are the ones which are being disrupted, and or basically have-nots, which is where they have not rebounded coming out of this.
Well, that's a great segue into my next question. That value versus growth debate. You talked about a little bit that the money's not flowing into those value companies that have lower valuations, that have lower growth prospects, that maybe have been more challenged in this work from home environment. Let's take a step back, and if you can just give your view on, you wrote something recently on the challenge for value investors. If you can summarize that and then talk going forward, and you're growth oriented, quality growth oriented. So we know you come at it from that lens, but I think it's helpful to just hear your perspective on this from a kind of long-term viewpoint.
Yeah. So just to give you a full perspective, I've been accused of being a value manager. I've been accused of being a growth manager, because our view is you need both. So I think the important thing is that, first of all, growth and value are not really oil and water as folks make it out. At the end of the day, you really want the highest quality growth you could get at the cheapest price. And there's a good tug of war. You're not consciously going to overpay. What has happened is that there's been bulk of the low multiple names, let me put it this way, are the names which either have cyclicality to it or are being disrupted. And I feel that has not been fully appreciated. In fact, if you look at the piece that you mentioned here, over the last 25 years, so you take a long enough piece, right? Let's go back to pre-dot-com bubble. What has been the EPS growth as such between the value indices and growth indices as such? So the reason why value has underperformed is the EPS growth has been much lower. It has not been multiple expansion on growth side and multiple compression on the other side. If you look at a normalized basis, which is what we wrote in the piece, it is not simply multiple expansion that growth has gone to gaga territory like .com. Actually, I don't feel anything close to .com. And by the way, we were massively underweight the technology and telecom and underperformed during the .com era. So the better years were 2001, 2002, and not 99, 2000, because they were in gaga territory without necessarily the underlying fundamentals being solid. So if you look at last 15 years, bulk of the outperformance will come from better EPS growth. That's true pretty much everywhere in the world. Now, some of the more low volatility names have actually seen multiple expansion, but you won't necessarily say that everything has become multiple expansion. And I think that is the real issue, that the markets, I feel, have been savvy enough in not giving a higher multiple and giving a slightly lower multiple. So you have seen compression from like 16 to 13 times kind of range on lower, on some of the more cyclical areas. So I think you have to differentiate between cyclical cheapness and sort of secular disrupted businesses. Retail, for example, some of the financials, not all financials. Some of the financials are just cheap because they're cyclical. Some of the basic material names, they're not being disrupted. So you have to differentiate between what is cheap because there's a disruption, what is cheap because of what is cheap because of cyclicality. And I think that we feel has been a big part of the messaging within the markets, is that folks who simply bought low multiple names have ended up in cyclical areas, and hence in the slowdown, in an economic slowdown scenario, obviously they would get killed because you're buying cyclical areas where the E would disappear. So I think the whole notion of, you see these ratios, everybody's sort of putting out these ratios of growth and value, how steep they are. It is actually, you got to be very careful with the ratio, because that assumes that the E on the value side is there. Earnings may disappear. So you need dependable earnings stream to even calculate that ratio in a more sensible manner.
So how about the growth aspect of it, though? Is the higher growth of growth companies just as much at risk as the earnings themselves are for value companies? I think the basis for growth versus value is that growth companies are expected to grow more, but the value companies are underpriced for the growth that they can deliver. And I guess the question when we look at it is that value is so extended now. It's in depending on the measure you look at, 90th, 99th percentile in terms of underperformance relative to value. Have the expectations for growth gotten so strong, even in this environment where there's so much uncertainty, that even as value looks really weak, value can hang in there better?
Yeah, so it's a good question, because if you look at the most expensive or the fastest growing decile within the growth cohort as such, that is expensive, and that's it. Everything is being valued price to revenue, price to sales, right? I think that's a dangerous area, because that assumes that everything is bright and sunny and is full speed ahead. And which is why I'm saying that in third bucket, which may end up shifting to second bucket, because if this duration of shutdowns extends longer, they will be affected too. So we feel that the best area is not, let's say, if you put in terms of growth, EPS growth, the best area is not businesses which are growing at 15% plus, because there'll be few and far between, or you pay so much that the risk of disappointment will take away the returns. It is actually between mid-single digit to low double digit at best. That's the sweet spot, because that's where you're probably not paying too much. You're probably getting better balance sheet quality, obviously doing company by company. You don't want to go, anybody who says we go for growth and everything is going to grow double digits, in an environment, slow growth environment, the risk of disappointment has gone up way too much, number one. Number two is, I think the growth investors are not fully appreciating is the risk of rising rates. As far-fetched as that seems, sitting here and now, it's not impossible that you start seeing by third or fourth quarter some pickup, unless the Fed ends up suppressing the full yield curve fully, including 30-year. You might seeing some sort of pressure on the upside. If that happens, I'm not forecasting that, by the way, but if that happens, the multiple expansion that has taken growth side may come under tremendous pressure, because let's not forget, most of the growth investors have had great record in last 15 years. There are not many who had good record in 2000, 2002 era, 2003 era. And that's because in a declining rate environment, multiples expand. And now, yeah, you don't have to predict rising rate environment, but it's hard to see how rates go meaningfully lower. Maybe go to, zero. Maybe go to minus 50 basis point like Europe. They're not going to go to minus 3, minus 4. I hope not, at least. Right? But I think that is the real risk of you not only paying too much for the growth, which may slow down, but you also get multiple compression risk, because if rates, and you saw a glimpse of that in second half of 2016 and last quarter 2018. So you almost have to see, okay, how did the portfolio react in that era in a rising rate environment? And I feel a lot of folks may not be incorporating that enough from a portfolio construction perspective. So we feel that the best opportunity is businesses that have higher degree of dependability, but they're not necessarily the faster growth. So actually, multiples on our portfolio, we are constantly trying to bring it down to a certain extent, not also trying to bring it 8 or 10 multiple, by the way. So I'm not focusing on a particular number, but every name, you really want to reach out for very, very select few, because that's where you get into, to your point, get into a territory which could be a little bit tricky.
Well, you mentioned rising rates, and you said you're not calling for it, but I'll ask a related question, and it'll be my last question. And I should have said from the start, I'll just remind everyone, we'd love to have questions. We do have a few coming in already. We'll turn to those after this final question from me. But in your WebEx, your GoToMeeting grid, you can see the chat box. Feel free to fire a question in there, and we'll do our best to get to all of those before wrapping up with the lightning round. My last question is related to that rising rates comment. Inflation or deflation, it sounds like in the near term, you're not calling for much inflation, but do you see risks of inflation or meaningful deflation as we get out beyond COVID-19, 18, 24 months out?
Yeah, I mean, to be very, very clear, we are bottom-up stock investors, but we do have a sort of macro switch off, because I feel that macro sometimes is a very good risk management tool. And it's very convenient to say we only do bottom-up and we could care less what the environment is. This is a perfect, setup where, well, paying attention to macro matters. So to answer the question, I think obviously this short-term should be deflationary. It feels like that. And you're seeing that. I think the jury is out, because you did not see broad money supply growth in the prior crisis, like 2008 or post 2008, 2009. We will have to see how that impacts this time. So our view is that you don't want to, coming back to what I mentioned before, that you want to make sure you want businesses that have pricing power and can manage it a little bit better. And by the way, not all software companies have pricing power. Not all staples have pricing power. Actually, some of the financial may have more, not pricing power, but better inflation protection tendencies. So if you have a manager who says we never own financials and we never own commodities, if you do happen to get into a higher inflation environment, you may be in for a nasty surprise. So we feel that we need to have, a sort of a much more barbell approach, still buying high quality, sensible prices, but businesses, how would they, if inflation does tick up, how would that behave? Not necessarily try to buy all of them tomorrow, but just to have a sense of how they would behave. And commodities are not always good inflation hedges, but some of them could be better inflation hedges.
Well, I said that was my last question, but you said something really interesting that I'd just love to dig into a little bit more there. That software, not all software companies have pricing power. Can you just spend another minute on that? Because I think the narrative over the last the last several years, but in particular the last 10 weeks as we've been in lockdown, and the the importance of some of these software companies has been shown to all of us. It's just a view that that all software companies are great. Can you talk a little bit more about that differentiation of those that have pricing power and those that don't?
Yeah. So if you look at businesses that are mission critical, software that is mission critical, and they are relatively small ticket prices. Let's take it, one of the largest companies are Microsoft. So if you look at their Windows or Office 365 or any of the other products that Microsoft sells, it'll be very hard for anyone to shut them off. In fact, what we're seeing in some of the emerging markets is where there was a lot of piracy. You've seen actually the revenue pick up a little bit because of, when people are working from home and they're using Microsoft products, they actually now they have to pay them to run those products. So that'll be mission critical and would have some pricing power, although they're not exercising that. On the other side, there's software, which is they tend to have high churn. So one of the indicators, obviously, you can see is software companies that tend to have higher churn. That means either they're selling to small businesses and there'll be literally millions of small businesses that won't survive, or it's easy enough to switch. And there are a bunch of software. We have switched, for example, and this is my personal experience at GQG. We have switched some software vendors, which I was surprised how easy it was to switch as a user. And I don't want to name names here, but some of the companies that actually have owned or we looked at. So these are large cap names, by the way, and it wasn't that difficult to switch, and they do tend to have higher churn. So we feel that not every business, a software company, would be as sort of bulletproof as the perception is. Second part is, even if the software company is growing by, in penetration, existing large enterprises, well, if they're selling to, let's take a name, to GE, would GE be buying more seats from them? Maybe, maybe not. So that has to be incorporated in your analysis. And I feel a lot of software companies would not stand the test of time. I would say actually more than half would not stand the test of time, because everything is subject to negotiation. By the way, we have seen, for example, as we talk to dentists, and by the way, that's kind of how we try to get a much more broad landscape. And sometimes Wall Street doesn't get that because it's kind of an echo chamber. So we try to go outside that echo chamber using, our former investigative journalists. You talk to dentists and they're saying, look, we have been able to negotiate some of the software tags that we pay for in a 30, 40, 50% discount, which was actually surprising, but that can happen.
Great, thanks for that. Let's turn to some audience questions here. I'm going to go to the one that came in most recently because it's very relevant to that. We've had another one since then, but very relevant to that growth value conversation we were having before. How much credence do you give to changes in companies that are less capital intensive, and thus it's the changes, the growth isn't picked up in the accounting principles versus those capital intensive companies, and how much that's the driving force behind differences in the returns of growth versus value?
Yeah, so that is an important part of it, because especially if it's kind of surprising that folks still use price to book. I mean, the large shops use price to book, which is kind of surprising, because price to book essentially, let me give you an example to sort of, to crystallize what the question was. If you have a pharmaceutical company, the R&D goes through the P&L. If you have a consumer staple, the advertising and promotion, which is the biggest asset that they have, goes fully through the P&L. If you're on the other side, let's take an industrial, where you're manufacturing something, you spend, let's say, $100 million on that, but that is capitalized, and then if it depreciates over 20 years, then 5% thereabouts will flow through the P&L, right? So the multiples tend to incorporate that. So if a business, consumer staple, is writing off 15% right through the P&L versus similar amount of asset, to simplify the example here, only 5% going through, you got to adjust for that. So not just R&D and other stuff. So a lot of the multiple difference tends to be that. And financial, for example, I mean, the argument that banks are cheap at 10 times is frankly a little bit amusing, because banks are not going to sell 20 times. The simple reason, the banks are inherently leveraged companies. I mean, a good bank is maybe 10 times leveraged. An average bank is maybe 13 to 15 times leveraged because the equity tends to be between 5 to 10%. If you go back to 2007, 2008, some of the European banks were 50 times leveraged, 50 times. So 2% equity. It didn't take much for them to disappear. So the markets recognize that everything gets leveraged. And that's why they sell 10 multiples. So I'm always surprised when people say, well, bank, Citibank, not naming any names, but take any bank, which is selling at 10 times earnings. Yeah, it may be a fantastic franchise. And we have owned a lot of banks, but it's not going to sell at 20 times either. On the other side, they may be a fantastic, let's say, staple or software company, what have you, which is 25 times. But the cyclicality would be determined by the operating leverage and sometimes the financial leverage. So to answer the question, yes, the big part of the difference tends to come from capital intensity that the business has.
Okay, and we talked a lot about the difference in performance, the outperformance of growth versus value. We have a question here about performance disparity, this time between U.S. markets and international markets over the last dozen or so years. Can you briefly explain why that happened, and then give your forward-looking view of what you see going forward for U.S. versus the rest of the world in equity markets?
Yeah, so the two parts. One is clearly the dollar has been stronger, and for a whole host of reasons over the last 10 years. So that has helped or hurt, some of the non-US returns. And you see that emerging markets, in developed markets, but the non-US currencies are generally on a cheaper side. So I think if you look at 30, 40 year, let's say 50-year history, dollar has not been a strong currency because US has typically run a meaningful current account deficit. So that's a big part of it. And Europe is running a big surplus. Singapore and a bunch of other Asian countries do run a surplus too. So that tends to be a decent long-term indicator. So the currency tend to go in cycles, but dollar has generally been a weaker currency over the very long run. But you get this interim cycles in between, which affect your returns. The other part is obviously earnings growth. So earnings growth has been much more softer. And a big reason is obviously the industry composition of the indices. So if you look at, for example, the European indices, they have a much higher financials, industrial, and in general cyclicals. Same in Japan. And in last 6-7 years, you have seen slower global growth environment, which has led to underperformance of those industries, which has led to underperformance of those areas. The question is that if you take a 5-year view, and if you're a large allocator, that's what you really have to take that long a view. Could that change? And if that changes, then you could see outperformance in those areas. On the other side, US has also benefited from much higher, now you can say financial engineering, much higher share buyback, and so on and so forth. So let me give you just one data point. Japan, more than half of Japanese companies in Japanese index are net cash. I believe it's a 10 to 12% of the S&P 500. So the share buyback, in fact, there's a much higher buyback now happening in Japan than I believe in the US. I don't have the exact data, but just these sort of the bigger picture data that I've seen. And the reason is because they were not buying back stock, and they were criticized, including by people like me, by the way, that they are not buying back enough. And here they are, that in this crisis, they have the ability because they are sitting a lot of cash, and maybe the cash they're sitting on is a function of the kind of the mental scarring that happened because of the collapse that you saw in early 90s. And you see that behavior time and time again. So I feel that from a performance perspective, if you take the non-US has underperformed. However, these tend to go in cycles. So I would not extrapolate that. So if you're sitting here in 2010, you hadn't made any money in US, and bulk of the outperformance come from non-US. If you're sitting in 2000, it felt like what's happening today. The prior 10 years, US had been the best place. Non-US had not done well. Again, if you remember, 90s, tech did very well. So I think you got to be careful in that part. Now, however, there's a totally different aspect, which I haven't seen much talked about. And maybe I'm speaking for the endangered species these days called active managers, which is that if you look at large cap US value, that has actually not done that much better than emerging markets. right? So if you look at our international, we've actually added more value than the S&P international. So it really depends on who you're picking. It's not simply a category discussion. If you were large cap U.S. value, well, it didn't make much of a difference. You could have done equally, if not better, than a whole bunch of other non-U.S. places. So it gets a little more nuanced. Simply U.S. If you say U.S., it means S&P 500 only. Then yes. But if you go anything else, then it gets a little more nuanced.
It's interesting. The large value and EM perspective is very interesting. One quick follow-up. You mentioned the scarring in Japan, companies holding more cash. Do you think there's a risk of that in the U.S. or other places in the world, based on what's happened so far with the economic shutdown due to COVID, and if that takes a long time to play itself out?
Yeah, no, actually, that is part of the thesis that I feel that a lot of companies would have to build up. So the three parts. First is you have to pay down the debt because companies would want to be more cash rich. Second is you have to build up even more cash to, not just to pay down debt, but keep extra cash. And then you're not going to buy back stock. The third is margin expansion story. Margin expansion, in a lot of cases, was optimization of working capital, running everything tighter, just-in-time management, right? If you look at hospitals, why did we run short of everything? Well, if you have 1 month worth of mass versus 6 months, or typically, I'm just making up the numbers, versus 6 months, guess what? Your working capital requirements go down, your balance sheet looks much more, quote unquote, efficient, but you're putting the whole security at risk, right? I mean, security has gone away. So I think all of that will make somewhat a comeback, depending on the industry. And that means that the balance sheet will become arguably less efficient, but more secure. And that's rather good for the system. And I think shareholders should applaud that, because the last thing about is outages, shortages or what have you. So all of that means that the margin expansion story would be weaker. But the other part of margin expansion is premiumization. One of the fallouts we feel, and we are in early days, and you're seeing savings rate go up, is they will be sort of, not in a big way, but some sort of return to frugality. In other words, would the premiumization, if you look at, a whole bunch of, especially consumer-focused businesses, and if that happens, and you're seeing early signs of that savings rate go up, and you saw that, by the way, European savings rate went up quite a bit since the European crisis in 2011-12. So the margin expansion story will also be very hard to get. The third leg to all of this is margin expansion happening because of outsourcing to Asia. And I feel that the US-China relationship, and now actually increasingly Europe-China and Australia-China and other emerging market China relationship, is getting strained. It is not simply US. And that, because of the COVID and how this, maybe there was not enough, information passed on, that could change the supply chain dynamics. Changing supply chain dynamics would mean that margin expansion story would be basically done. And that has been a big part of the increasing free cash flow as a percent of sales over the last almost 20 years. Since China entered WTO, you have seen a pretty secular improving margins in a whole host of industries. That may be coming to an end. So to make a long story short, that is part of the reason why we feel that I'd rather take more secure 8% EPS growth than get excited about 18% EPS growth.
That'll be interesting to see over the next few years. One last client question, nice easy one to wrap it up before we go to the fun lightning round questions. What is the risk that our current recession will turn into an actual depression?
I think that risk is a little bit lower than I would have thought maybe a few weeks ago, let's say 8-9 weeks ago. And the reason is that if you compare to, and again, I'm no depression expert, I'm not a fixed income expert who probably would have much, so you should take this with a pinch of salt. Is the depression, there was bank failures, the Fed reacted too slow. And there was some marginal differences, but there were important differences. Was, for example, there used to be double liability, right? I mean, so if you're a bank shareholder, you not only were responsible for the equity they put in, you could be held accountable even more than that, right? So the bank failures were left and right, and that actually wiped out the shareholders too. and that actually shrank the money supply in a big way. So there were a whole host of differences. I mean, if you go back, and I believe it was till mid 1931 that Hoover was still talking about balancing the budget. Okay, this is mid 31 or thereabouts. So I think there's a meaningful difference in what that happened. So it'll be sort of, I feel it's too convenient to say it's going to be that. The second part is these kind of crises that we're seeing now tend to be not longer lasting. In other words, they typically don't last too long, and the rebound tends to be faster. It doesn't mean it's a V fully, but they typically don't tend to be sort of prolonged depression-like. So maybe I'm a kind of equity glass half full guy, but I feel that there's a meaningful differences if you look at sort of the nuances in what happened in the Great Depression and what's happening now.
Well, great. That makes you our most optimistic of our guests so far. So we appreciate that slightly rosier outlook. Rajiv, let's wrap up with a little fun, the lightning round questions. First, what is the thing you missed the most while in lockdown?
Well, I think there's a lot of camaraderie that's there when you go to office and talk to folks and so on. So I think if you ask me, that's the biggest one. So in second is just being able to walk to grab a cup of coffee. I mean, I think you start missing the smaller things the most, more than something going on a big vacation or something. I feel, at least in my case, the small little pleasures day to day, those are some of the basic stuff that you start missing the most as time passes.
Sure. What's been a pleasant surprise while stuck at home?
Well, I think it's not a total surprise, but still been a surprise that you do become more productive, and I feel that's why I wouldn't be surprised this kind of becomes how we operate in a meaningful way, and that could be a huge positive if you want to look at that way. That how we operate, if people start working from home, the time for commute, the productivity in general goes higher in a meaningful fashion, and that really opens up. I mean, you can basically hire people anywhere. If you don't have to hire in New York City or LA or San Francisco, then you can essentially hire in Kansas. You can hire in Florida, all the company by San Francisco. So could that really expand? It becomes a much more mobile. So I think that might be something which is interesting
Great.
to watch.
How about a show, movie, or book you've enjoyed the most during this stretch?
I haven't really watched too many movies, frankly. It's been kind of a little bit busier than usual. But there's one book which I think is actually interesting and is actually not a negative book, a pessimistic book. It's Deep Survival. I think the writer is Gonzalez. So it's a 20-year-old book, but it actually talks about traits of folks who tend to do well during these kind of not this, but accidents and and so on and so forth. So it's actually pretty interesting. And I'll give you just one peek into that is that it's not the Rambo types that survive. It's a little more meek who sort of are optimistic and humble. They tend to survive the catastrophic events and so on and so forth. So the perception that you go guns blazing, that's not usually the best way.
Great. That sounds like an interesting read. The thing that people are not talking about or worried about enough is blank.
Yes, I think people are talking about it, but the longer term implication of this, one is how we behave, because especially if this lasts longer, because the unemployment rate is, depending how you calculate, is probably running 20% plus. So could there be longer term scarring? How would that change our day-to-day behavior, and the society? And people are talking about somewhat. And I think that's the one thing. The second one would be simply that if you look at the geopolitics of what is happening here, how could that change, and especially now going to elections and thereafter, could that mean a seismic shift in basically kind of a lot of countries are talking about self-sustaining in every which way. Doesn't mean that you are, and as I said, people are talking about somewhat of deglobalization in a much more meaningful fashion than what is incorporated in the markets as such.
Sure. And last one, do you have a prediction on a way our world will be permanently changed?
Yeah, I try not to make too many predictions. uh, yeah, I think it's just we just to wait and watch how things evolve, because if you do not get a resurgence, I think the world may change less than what people feel sitting today. So it's really all a function of the duration of this. And there was an article by the prior FDA commissioner that maybe the herd immunity can happen at a much lower level. That would be fantastic news. If the herd immunity happens at, let's say, he was saying 10%, but even 20-25%, that'll be a huge deal versus, it has to go to, versus 60-70%.
Let's hope so. That would be great. Well, Rajiv, thank you. This has been awesome to hear your perspective, talk a little bit about value and growth, and just go around the world really to see what's happening across countries and across sectors. So thank you so much for joining us today. Thanks to all of our clients for joining us on the phone once again. And we look forward to having you back on next week at this same time when we have Rick Reeder, Global CIO of Fixed Income from BlackRock. So Rajiv, thanks once again.
Thanks, Tim, and thanks for having me.
Take care.